So let's get started with trends and trend lines. Now, as a trader, you have probably heard the old adage that it's best to trade with the trend, or hence the trend is your friend. The trend, say all the pundits, is your friend. This is sage advice as long as you know and can accept that a trend can end at any time, and when it ends, it is no longer your friend. So how can you determine the direction of the trend? I believe in the KISS rule, keep it simple, stupid. So here are a couple of methods that we use to determine a trend, and a simple method of anticipating the end of a trend. Now, in order to understand and anticipate a trend, you first have to realize a trend is not really rule-based. A trend line is rule-based. A trend is the general direction in which a market is moving. It can be going up, or it can be going down, or it can be go sideways. And most of the time, which surprises most people, the markets move sideways. Now, when the market is trending up or down, it does follow an amazing set of general principles. We also have short-term trends, long-term trends, and intermediary term trends. We can have intraday terms and 30-minute trends, and different types of traders use different trends or different time frames to determine what type of market they're looking at and what type of an investment they would want to make. So the goal here is to determine the trend direction, not when to enter and exit a trade. Because exiting and entering a trade are done on specific time frames based on strategies. But the trend will help you decide whether you should be going long or short. Now, of course, this is not to say that there are no trading opportunities in shorter term time frames, such as daily or hourly charts. But those traders who want to trade with the trend rather than trading the correction, one could wait for the trend to resume and again trade in the direction of a trend. A trending market is one which price is generally moving in one direction. Sure, price may go against the trend every now and then, but look at the longer term time frames to see if it's just not a retracement or a correction. Now, trends are usually noted by higher highs and higher lows in an uptrend, or lower lows and lower highs in a downtrend. So let's go over and take a look at some charts and see if we can see what an overall trend looks like. So here we are looking at the current chart for the euro-US dollar. Now we can see in the short term, which this chart is taking us back in, say, a month. No, this chart's only taking us back a couple days because we're looking at a 4-hour chart here. So on a 4-hour chart, we can see that overall, the euro is trading in a downtrend. Now, it's trended down, it's had a correction back up and moved back to its downtrend. And that's the way a trend should move. Trends don't move in just one direction. Price doesn't move straight up. Price moves up, comes back down a bit, we call it retracement, comes back up, forms a retracement, and comes back up. These can be called waves or cycles because it takes a lot of energy, a lot of trading by the buyers to keep pushing the market up. Also, when a market is falling, we have the same. It takes a lot of work. Now, we can see in this market, we've had uptrends, downtrends, short-term trends, and long-term trends. If we were to click on this chart and move it to a one-day chart, we would see the euro in a different perspective. And then if we were to go back to a 1-month chart, we would see a completely different perspective of how the price is moving. But if we bring it back to a 30-minute chart, we see something very different. So we would want to use 30-minute time frames to possibly get our entry and exit points, where we'd want to use a 1-hour time frame to view a better view to see whether we're in a retracement or a actual trend, and a farther period out to actually identify that trend. Now remember, what we're looking for is first identifying the direction of the market, up or down, or sideways. We also want to identify where this is in the overall value of things, because the euro could be trending down in a longer term, and we'd want to know that, okay? Because you want to know where you are positioned in the life cycle. Okay? And so a trend doesn't really have hardcore rules. It's just like women's dress lengths or high heels or the color cars are being bought or whether we're going from SUVs to pickup trucks to sedans to two-seaters. What is the most popular at the moment? Now, we would like to go back historically and look and see. We know that silver and blue cars were the best sellers over the last few years. But if we look back historically, we can see that overall white cars sell better. So we know when we see a drop in blue and silver, we should be manufacturing more white cars because white always stays around. But it could be bronze that's becoming a popular color right now. So we'd want to see where bronze was in the long term and the short term for the color chart. Same thing for assets. Okay? They are just typically predictions or outlooks of how the sentiment is actually moving and how historically the assets have moved. Now, one of the best ways to see this is simply eyeballing. Other than eyeballing price action, you can make use of technical tools that you've learned to see whether a pair or an asset is trending or not. Now remember, there are three kinds of trends, and we should not ignore sideways trends or congestion. Now there's lots of traders that like to trade congestion, but these are trading strategies more or less than market information and market knowledge. I don't trade sideways movement. Okay, I trade only strong uptrends or strong downtrends because what you want to find is the most highly probable, highly profitable opportunity you can find. So there are all kinds of strategies out there, all kinds of contrarian views about trading opposite trends. Okay. Do these work? They work for some people. But if you're a smart trader, especially a new trader, what you're looking for is the highest probable profitable trade you can make. And the big mistake with new traders or inexperienced traders is they want to trade as many trades as you can. They want to trade every day and get lots of trades in. Well, me as a whole, I'm lucky if I get 10 trades an entire week, and that includes my swing trades, which may stay in place for 30 or 60 days. Now, do you need to trade many trades? If you want to be a day trader trading little increments, okay, you might, but you still want the highest probability of success. And you get this by determining the trend and only find markets that are trending, because then you can properly analyze this market instead of guess. So along with these three trend directions, there are three trend classifications that have to do with time duration. And this is long-term, intermediary term, and short-term. And as we see in the chart on the screen right here, by understanding the asset, and this is the euro, the US dollar, Canadian dollar, the loonie, okay, we see that overall the loonie is in a long-term trend up. We can see that we've had short-term intermediary trends. So if we were looking for a short-term trade, we would have looked to trade in this intermediary, the short-term trend. But if really, in reality, it was simply a retracement of this pushing up trend. So you want to know that, because if you had established this trend line for the longer-term trend, guess what? As this was cycling down the retracement, you would have known that it was most likely going to bounce off of the established trend line. Here we get a medium-term trend, which is a beautifully validated trend line. And it would have given us another trading opportunity, but we would have known that was a pretty strong trend because it was supported by the longer term uptrend. So this is why it's important to be able to define trends. Now, one of the easiest ways or best ways, and I'm going to show you this in an active screen, is simply moving averages. We can use a multiple moving average and watch for the moving averages to fan out from each other to tell us whether we actually have a existing trend. So when we use a shorter term and a longer term moving average, when the shorter term fans out from the longer term, that tells us the market is trending. Okay, one's a trend up, one's a trend down, but it's a way that'll help us identify the trend. But overall, if we would have looked and used our eyeballing method, we would have seen this market was an uptrending market, because we would have looked at it over many time periods and we could have established it that way also. So the moving averages could have helped support our understanding. Now, there's also all types of indicators that will help us determine if a market is trending. So one tool that's often used for range-bound markets can also be used to help us discover a trend, and that's Bollinger Bands. Because everything is said to happen within the Bollinger Band, but when we see price riding the band, here where we see this is the upper band of the Bollinger Band, the blue, and we see price hugging that as it's riding up, we know we have a trending market. But there are different ways that you can determine or establish an actual trend. And as you notice, I haven't given you any hardcore rules about a trend. It's simply a price moving up, making higher highs and higher lows, going through pushes forward, it eases down, pushes forwards, and easing down. So Bollinger makes it easy to confirm a trend visually. Downtrend can be confirmed when price is in the sell zone, and uptrends can be confirmed when price is in the buy zone. Now, we will want to start establishing some understanding of this trend. Again, we haven't gotten to trend lines yet. Trend lines are the first rule-based indicator you need to put on your chart. But before we get to that, we can talk about the waves or the cycles of a trend. Now, the markets accept the principle that the markets move in a trend. They push up, establishing higher highs, and then we'll ease down in what we call a retracement, okay, and then move back up. Now, this retracement always stays above the previous low. Okay. It's also established that wave 3 is usually the longest. There's no have to be rules. These are just principles. So we have push, ease, push, ease, push. And an established wave usually consists of 5 impulses. Then it goes into a small correction phase. And then we'll reestablish its 5 cycles back up. Okay. These waves are called impulse waves when in the direction of a trend, and corrective waves when contrary to trend. Now, there's some people who use a 7 cycle, but on the whole, a 5 cycle is the accepted one. Then we have Elliott wave principle, which is even a little bit more specific. By counting the waves or pivots in each wave, one can attempt to anticipate whether a trading opportunity will be against a trend or with the trend. Now, according to Elliott wave theory, an impulse wave usually consists of 5 swings and a corrective wave usually consisting of 3 swings. Now, we can find this in a 30 or 60-minute chart. We can then use a longer term chart and actually fold this in. And what you want to do is continually, if you start with a 1-day chart, okay, you can find all of these waves existing in the 1 day. When you find that wave or that impulse, when you sneak it down into a smaller time frame, you can find the wave or the pivot or the cycle within that shorter term move. Now, the image gives an example of an Elliott wave because Elliott wave theory can be very subjective. I prefer to use pivot counts to help me determine wave exhaustion. This usually translates to a minimum of 7 pivots when going with the trend, followed by 5 pivots going as a correction. Pivots are points. Again, 1, 2, 3, 4, 5. 1, 2, 3. Sometimes the market will not cooperate with the technical assumptions, but it can occur often enough to provide very lucrative trading opportunities. So as we note on this chart, we have wave 1, correction. Now it's just the opposite in a downtrend. Wave 2, then we go into wave 3, which is the longest wave down, correction on the wave 4, back down to wave 5, move up to 6, and back down to 7. This was a very nice 7-point impulse wave. Okay, gave us lots of trading opportunities. So the bottom line is, by combining the moving average diagnosis with pivot count and then fine-tuning the analysis of the observation of maybe candlesticks, a trader can stack the odds of making a successful trade in his or her favor. Now, this will help you make high probability success trades. Okay, and this is all we want to do is we want to start throwing things out of our trading scenarios. We want to say, okay, this is not a high probability. So this gives you a point of, and you may say, well, this is bunk. 5 waves, 3 waves, 7 waves, 5 waves. You know, that's fine. Okay, you don't have to believe in it. But when you see it established, you should be able to say, look at that. We have the perfect impulse waves. So the next wave should be this, this, and this. So you can factor that in and increase your odds of making successful trades. So remember, trading is a craft, which means that it is both an art and a science and requires practice to develop consistency and profitability. So one of the easiest, most reliable ways to make money in Forex trading is to follow trends and let winning trades run as long as they will run. And that's why we always look for the wave to enter somewhere on wave 2, the correction of wave 2, because wave 3 is usually the longest wave where it'll be the most high probability of success. But if you enter it in wave 1, you ride it up 1. You don't want to panic sell when it goes into the retracement at 2, and then you can ride it up 3 because 3 will be the longest wave in most cases. So when you trade like this, most of your trades are going to be small losing trades. But sooner or later, they will be more paid for the few huge winners. It takes some discipline to trade like this, but it's pretty easy. You don't need to be a genius, and even very experienced or knowledgeable traders to trade profitability this style. What you do need, of course, is at least one trend to exploit. When the Forex market is very flat and trends are completely absent, trend traders cannot avoid losing money. So it becomes more vital to identify trending markets. Now, the identification of patterns and trends are techniques used by analysts studying the supply and demand of assets traded over the open market. A pattern is a set of data that follows a recognizable form, which analysts then attempt to find in the current data. We do this by having rules. Okay. So you can easily recognize an uptrend or a downtrend. You can recognize sideways congestion. Okay. But you need to have some type of rules to get you off on or some type of recognizable pattern that will help you decide when to enter and exit markets. So analysts use trends, which are essentially boundaries of price fluctuation, and attempt to spot and define trends. Upward trends are characterized by an asset hitting a series of higher highs and higher lows, while downtrends are marked by a series of lower lows and lower highs. So let's go look at a live chart and see what we can find here. Okay, I've just got a couple set up for you, and I want to show you the ones that are more pertinent. So here we have Bitcoin, which we had a triangle forming. We had, now remember, in downtrending markets, we're looking over top of the price because the price is moving down. So we had a beautiful trend forming here. Price has been, as you all know, had been falling in Bitcoin. And it actually formed what is known as a triangle. And as price got pent up, as the demand got pent up into this triangle here, it had to break in one direction or another. In this case, it broke out and moved upward. So if you were waiting for it to break the trend line, you could have established a buy as soon as it broke the trend line and made a successful trade. When we add things like indicators and oscillators to it, we can start making trading decisions. But first was to find the trend and then find or put on something that helps us establish or some rules that can help us actually confirm that we have not just a trend, but we have something that's tradable with a price that we can anticipate. So we do this by putting a trend line on a chart. And a trend line is simply a line that supports the price movement. An uptrending market would have a trend line drawn underneath the prices, and a downtrending market, you would draw the trend line above the prices. We do this by connecting the lower lows or the higher highs to the next highs. Now, the thing about a trend line is it cannot be broken. It means price cannot break through this trend line. Once it does, that trend line ceases to exist. And you have to reestablish a new trend line. So what we can see here on our oil chart is we could have established this trend line. You look for trend lines to start establishing when the markets change direction. So we could have established this trend line here. Now, because prices declined and broken that trend line, the new trend line would be here, underneath the prices with no breaks through it. Now, all it takes is 2 points in common to draw a trend line. But when you draw that trend line and project in the future, if price breaks it, it's no longer valid. So then you have to redraw it at a new level because it's only important to you moving forward. Now, in this case, we were able to draw. Now you say, I can always draw a trend line if it only takes 2 points. But the fact is it needs 3 points in common to become what we call a valid trend line. So in other words, we have 1, 2, 3, and we're just establishing 4. Okay, this price and this trend line is very, very, very good because it has 4 prices where it reacted to the trend line and stayed above the trend line. We also have our waves. Look at this. We have push, ease. We have 1, 2, push, ease, 3 and 4, push, 5. And now where are we going? We're going into the corrective 1. Exactly like we talked about in the PowerPoint. Now, isn't this amazing? I didn't set this up for class. This is how prices, this is the actual price of oil. Okay. This is how price moves in the waves and along trend lines. Once you can establish these waves and you can draw a trend line. Now, this blue trend line was a valid short-term trend line. This is a more valid longer-term trend line. But look at that. When price was moving up along this trend line, Let me just get these markings off your screen. And when price was moving up along these trend lines, this was a nice, strong uptrend. But as soon as it broke that trend line, now we didn't know what it was going to do, but we knew that exact price when that asset hit that trend line. So we can then look for our market action or reaction because we've established a price that's important to the markets. So we can then look to see whether price stays above that trend line or breaks below the trend line. It doesn't say that the trend is over. Just when it breaks that trend line is invalid, and you have to draw a new trend because we're still continuing this uptrend. But you always want to have the most important price, and the most important price is from the most accurate trend line that you can draw. So when you redraw it, your new price of importance is that as this price is moving down is right on this trend line. So let's go back to my PowerPoint. Okay. There are a number of analytical tools businesses can use for trend lines and to get a picture of a trend in your business by connecting numbers of points on a graph. And it's not just trend lines aren't just for the Forex market, aren't just for financial markets. Like I said, if you were establishing colors of cars that are popular, or whether SUVs are outpacing, sales are going up or down for SUVs, and then are sales going up or down for sedans, well, you can establish trend lines for each one of those on charts. Okay. Now, in this case, we're more concerned with the euro or the dollar or the pound or the oil or gold. But if you were in the car industry, you'd be more concerned with cars. Okay. They all have basically the same rules for establishing a trend line. Okay. What is revealed is a possible downturn or an upturn in the direction of the group of variables or values identified by the data. Understanding how to use a trend line can help reveal what might happen in the future. Now, trend lines represent a charting technique, which is a line is added to represent the trend in the currency pair. Drawing a trend line is as simple as drawing a straight line that follows a general trend. Trend lines can also be used in identifying trend reversals. Trend lines are a useful tool for visually highlighting a trend and the potential being part of a trading strategy. See, right now we're talking about pieces of information. We're talking about analytic tools. We're not talking about a trading strategy. Understanding what a chart is telling you and putting important information on a chart is different than a trading strategy. Your strategy might be when the asset approaches the trend line, do we see an increase or decrease in volume while we look for a chart pattern, and maybe we use RSI and Bollinger Bands? That's a strategy. Okay? That is putting together different tools and different abilities to make a trading decision. So learning how to use trend lines effectively, if you're going to use them, is crucial so you don't fall into some very common traps. Trend lines are a technical analysis tool used to define and project price trends in major markets such as stocks, Forex, and futures. Trend lines have the potential to alert us of a pullback, or when a pullback is over, or the trend is resuming, or when a trend is accelerating or reversing. But price is the ultimate indicator. Therefore, price action must always be considered when using trend lines. So as you can see, an upward trend line is drawn at the lows of an upward trend. Notice how the price is propped up by this support level. During an uptrend, we see a progress of swing highs and swing lows. When the price creates lower swing high or lower swing lows, the trend is potentially in jeopardy. During a downtrend, we see lower swing highs and lower swing highs. When the price creates a higher swing high or a higher swing low, the downtrend may be reversing. Pullbacks within a larger trend, such as a pullback in a weekly chart, can often appear as trends on shorter term time frames, such as daily or hourly. So that's why you would look for a longer term trend to establish, say, the personality or the current position of where that asset is. And then the shorter term trend lines to determine where it is today, because we have where it's been historically and where it's coming from, where it is now, and then what we're always hoping for is telling us where the asset will be in the future. So understanding the basic concepts of price action is crucial because it applies to every trend we trade. If trading with a trend, we want to see this type of movement: higher highs and higher lows for an uptrend, lower lows and lower highs and lower lows for an uptrend. Now, price charts produce a lot of noise. Okay. And a lot of times we don't see the trend, or we don't see that the trend is over because of all this noise. Noise is the highs, the lows, the higher highs, the lower lows, the candlesticks, the japs up and down, because price moves all the time. It is always moving. So noise is the small random movements that can make it hard to spot a trend. Therefore, many traders prefer to simplify their charts. And a trend line will help clean up your chart, will help you delineate and see the clear price movement. So remember, anytime that there are two highs or two lows, you can draw a trend line. So like we see here on this chart, we established two swing lows here, and we drew a line out in the future. Now, this is a unvalidated, unqualified trend line. It's very easy to connect 2 points and draw a line. You need at least a third point to validate that trend line. Otherwise, it's just a line on a chart. So by forcing ourselves to draw all relevant trend lines, especially at the far right chart, the most recent price action, we may realize our bias wasn't correct at all. Being able to see trends and pullbacks of different sizes will aid us in our overall trading analysis. So trend lines are not only based on price, but also have a time element. This creates a greater myth. Traders will often say that because the trend line is broken, the trend is over. Remember, I told you that before. A trend moving up, continue going up. When it breaks a trend line, doesn't mean the trend is over. It means that trend line is no longer valid. Okay. So this is very common when price is moving sharply higher or lower. All it means is you have to draw a new trend line connecting those lower lows to the current low, so no price is broken through it, to qualify and quantify if that trend is continuing. Trend lines are not only based on price. Okay. For example, if the price is making rapid higher highs and higher lows, the trend line will be angled very, very steep. This type of momentum can't last forever. Okay. In fact, it's a very dangerous type of momentum because it can end very, very quickly. So the price, when it eases off, not when the trend line's gone, there's a point where you have lots of buyers entering the market. Something happened. You have news headlines. Donald Trump did something crazy. Bitcoin did this, and the price starts moving up and is forming an uptrend and moving in these movements up and down, doing very well. But at some given point, the uptrend can continue, but say the amount of buyers or the buyers jumping in the market aren't jumping as fast. Okay. Or they're saying actually got to the top. It's not saying it's over. It can continue up for ages. Okay. It's just, it's got to at some point gather some sensibility. The trend slows down because the depth or the steepness of the trend line tells you how much momentum that trend also happens. It will also help us see when the trend might be ending, because as the momentum eases and ceases, imagine a rocket, you fire it up in the sky. It moves higher and higher and higher. If you shoot it straight up, it's going to move higher. If you shoot it, out into the horizon, it's going to slowly move up. If you shoot it straight up, it's got lots of momentum. Or if you shoot it out towards the horizon, it's going to have less momentum, but they're going to continue out. At some given point, the momentum is going to start waning. Now, that rocket will still continue going up as that momentum wanes, but there's a point as that momentum wanes that rocket's going to tip and start moving back down to Earth. Okay. Now, because a rocket uses very specific scientific tools, we can use that to target user as part of targeting, because we can shoot off a rocket. We know where the momentum will wane, and we know where it will, because we have gravity included and everything else. But we can then, when we can see that momentum waning, we can also see a tipping point. So just remember, trend lines will often need to be redrawn. They are not a perfect trading tool that tells you exactly where the trend will reverse. You will draw a trend line connecting highs and lows only to see that the next price wave doesn't match up to the trend line exactly. Now, you must decide if you want to redraw your trend line to accommodate these misalignments. And you always want to have a trend line that's not broken. There's all types of strategists and gurus out there telling you things that, okay, and I will use one price break, especially if it's a low, not if it's a close, but if it's a low, because sometimes if something happens and the market drops down real low, or something shoots it up and it's only one candle with a new high or a new low, that could be a freak an accident. So as long as it recovers above that trend line, immediately thereafter, I allow it to happen. But that's my personal decision. So there are three very important keys to drawing effective trend lines. The higher time frames will always produce the most reliable trend lines. Most trend lines you come across will have some overlap with the high or the low of a candle. But what's important is getting the most touches possible without cutting through the body. Never try to force a trend line to fit. If it doesn't fit, the chart then isn't valid and therefore not worth having on your chart. So the goal of every trader is to buy low and sell high within a currency price trend. Trend lines give us a way to identify the high and the low ranges of the trend. As an example, if we are looking to buy a currency pair with the fundamental view, and it is pulling back to the uptrend line, this gives an area to buy a currency at a low price in the current trend, or the exact is of the reverse. So understanding trends and trend lines is basically crucial. It should be the first part of your job once you've decided to look at a financial chart. Identifying a trend isn't all that hard. Seeing the waves in the trend isn't all that difficult. Seeing the depth and the momentum of those charts of that trend isn't difficult. Applying a trend line isn't that difficult. Incorporating your trading strategy and decision making is a different story. Okay? But that is part of your trading strategy. But everybody should understand how to see a trend and how to identify a trend line. And on that note, I'm going to say goodnight to everybody. Thank you very much for joining us, and have a great trading week. And again, go to www.alvexo.com, open up a demo account. There's no credit card required, and attend their academy to learn all about trends and trend lines, and use their charts to start establishing your charting abilities. Have a great night now, and we'll talk to you again later. Good night now.